morning, Real ECN listeners. This is your Forex market commentary brought to you by Real ECN. Today commentary discussion, we will touch base on the Aussie US dollar market. The Australian Labor Department posted one of the largest increase in part-time employment, while unemployment rate unexpectedly ticked higher amid a contraction in full-time employment. In addition to that, a shrinking Chinese import print can jeopardize the Australian export market. As the Aussie's fundamentals are beginning to show sign of deterioration, it has continued to remain supported on the back of a low volatility market conditions. However, the narrowing of the spread between the 10-year Treasury and the Australian government bond can ultimately undermine the support structure. I hope that this commentary will prove to be useful for traders in formulating a successful trading strategy. So, breaking down this commentary, first we will explore the technical aspect on the Aussie US dollar market. Here we have the Aussie US dollar on a 1 hour time interval chart. The narrative for the Aussie US dollar price action over the past week has extended a certain degree of volatility. The pair peaked out at the 0.9500 psychological level before the release of an upbeat US non-farm payroll print last week triggered one of the largest sell-off in the pair in over 2 months. The rebounds in the greenback forced the Aussie to extend its losses down to the lower 0.9300 level before the pair reconsolidate around the 0.9360 price point. Heading into this week's trading calendar, despite the absence of major Tier 1 and Tier 2 risk events out from the United States, a great deal of market-moving risk events derived from Australia and China. The Aussie began this week by retracing some of its losses on an upbeat NAB business confidence and an improvement in Westpac consumer sentiment reading. However, during yesterday's trading session was when the Aussie failed to sustain trading momentum above the 0.9400 level on the back of a fragmenting Australian's labour report. So despite an upbeat in employment change, full-time employment contracted, coupled with an unexpected tick higher in the unemployment rate. In addition to that, China also reported a contraction in import print and a shrinking trade balance. So, on an intra-week time interval, analysts believe that the Aussie will most likely find support at the 23.6% Fibonacci retracement sit at the 0.9305 zone. So, failure to close above this Tier 1 support level will expose the pair to the second tier support tier set up at 38.2% retracement at 0.9181. However, in the case that the bull can regain the upper hand over the bear, analysts believe that the Aussie can retest the former support turn resistant at 0.9422 zone. So, taking out this resistance will ultimately expose the pair to the second resistant tier at 38.2% expansion at the 0.9507 zone. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, retail traders' outstanding open positions on the Aussie US dollar pair indicate that the recent price action peaked at the 0.9500 level may possibly mark a significant top as the current shift in crowd sentiment support further Aussie weakness. Recent retail traders' open long and short position are currently trapped in a convergent pattern. Therefore, at present, retail traders are trapped in an indecisive congestive trade. Analysis of a collection of technical indicators on an hourly time interval on the Aussie US dollar cross is suggestive of a temporary bearish market sentiment and recommend short position on the Aussie. The Aussie US dollar pair opened today's Sydney trading session 2 pips above the established Fibonacci support set at 0.9377 while the resistance is set at 0.9397. The Aussie US dollar pair price action broke below the 200-day simple moving average during yesterday's trading session. Therefore, this allowed analysts to downgrade the long-term outlook on the price pair to bearish if it continued to trade below the 200-day simple moving average. The significance of 200-day simple moving average cannot be underestimated, as 200-day simple moving average contain more or less of 1 year's worth of trading data. This bearish viewpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20 and 30 days short-term SMA, which is indicative of a sell recommendation on the simple moving average front. Now moving along to the fundamental aspect of the Aussie US dollar pair. Without a doubt, the Australian June employment report has been one of the most volatile market moving risk events this week. On the surface, the Australian labour report appeared to be rosy, showing that the economy added 15,900 jobs when expectation was set at 12,000 jobs. However, it failed to impress investors on the back of an uptick in unemployment rate to 6% when forecasts only expect a 5.9% reading. This rise in employment was largely responsible by an increase in 19,700 part-time jobs, while full-time employment saw a contraction by 3,800 jobs. This weakness in the underlying labour report only prompts speculation that the RBA will most likely remain accommodative for a longer period of time. Nevertheless, the sell-off in the Aussie was limited to this high-yielding currency continued to remain supported in the low volatility market condition. The Aussie US dollar pair and the Aussie Japanese yen pair is highly correlated to the carry trade vehicle and highly regarded as a carry trade vehicle. Therefore, as long as FX volatility and risk aversion continue to remain muted, the Aussie will most likely remain supported in the medium term. However, one concern that analysts believe that can fragment the support structure for the Aussie is the narrowing in the spread between the 10-year US Treasury and the 10-year Australian government bonds. This narrowing in the spread ultimately reduced the appeal of the Aussie as a high-yielding investment class and therefore can work to undermine its support against the greenback. Over in China, Australia's largest trading partner reported a cooling in inflation print with Chinese CPI year-on-year tick in at 2.3%, below expectation at 2.4%. In addition to that, the Chinese PPI year-on-year reported a 1.1% contraction when forecasts only expect a 1% contraction. Moreover, a shrinking in Chinese import year-on-year down to 5.5% below expectation of a 5.8% can hinder the Australian export growth prospect. Thank you everybody for listening and have a pleasant day.